Hey, welcome investors to the 40 Finance channel. We're going to have some fun today. We're going to dig up 12 stocks whose stock price today is at or below where it was in February of 2020. So we've got stocks that are cheaper today than they were pre-COVID. And the purpose of this video is just to give you something to think about as we watch all these stock prices fall right now in the midst of interest rates, inflation concerns, political tensions. There's a lot going on right now, but if you can see through the trees a little bit into the bigger picture, I think that you'll find there are legitimate deals to be had in the stock market today. Now, that's not to say that the 12 stocks featured here don't have their challenges ahead, but just from the sake of could you get it cheaper today than it was yesterday, and has the company made improvements to itself since then, I think makes for an interesting discussion point. All right, let's kick off with an easy one. I think we've all seen in the news due to its demise, unfortunately, Alibaba. And this is one that I would put on the map for, sort of political tensions, both internally and externally. The company has, of course, faced challenges internally from their own government. And then externally, there's been a lot of pressure on Chinese stocks, at least from the vantage point of U.S. investors. But if you can look beyond those things, you see a stock that back in January, February of 2020 was right around the $220 mark. Today, you're obviously at $127. Now let's take a look how Alibaba has performed during this stretch where their stock price has lost $100 or so. And on this chart here in SeekingAlpha, we're just going to focus on revenues to get down to the quick and dirty on this video. But we have 2019, 2020, and 2021 right here, as well as the trailing 12 months. From a revenue perspective, this company has grown revenues every single time period since 2019. So this is a great example of a stock that's making basically a lot more money today in revenues than it was making pre-COVID, yet the stock price is still down. All right, then, how about the future for Alibaba? And we look down here at EPS estimates. Does look like they'll shave potentially 17% off of last year's EPS. But going forward, at least as far as analysts care to look out, you've got double-digit growth on the bottom line. And on the top line here, revenue estimates, you got double-digit growth projected for the next 3 years and beyond. Number 2 on the list here is Facebook/Meta. 2020, right before the COVID crash, you've got about 217, 213, something like that, right in line with where you're trading today. Now switching over to revenues, and we'll go back to 2019, and they made more money in 2020. They made even more money in 2021, and that accounts for the last 12 months because they just reported. So no problems on the revenue side for Facebook, despite, let's call it a flat stock price. Okay, looking ahead on the EPS side for this year, again, you got a minus 10%, very similar to Alibaba. These are early in the year projections, so they could obviously change. But going forward, you got double-digit EPS growth on the bottom line. And as far as revenues are concerned, double digits in 22, 23, 24, basically as far as the eye can see. All right, stock number 3 is PayPal. This is one that I own. And back in February of 2020, you're at $116. Today, you're at $107. Let's see if PayPal made any more money during the pandemic years. And we'll scroll out here, 2019. You're in that $17 billion range. 2020, you got up to $21 billion. 2021, you're at $25. And that accounts, too, for your trailing 12 months because they just reported as well. So PayPal has continued to grow their revenue despite negative effects on their stock price. From an earnings standpoint, this year, a little flat, 1.23%. Now, I've done a lot of videos on PayPal recently, so you guys know that I think they will outperform, but let's just say it lands at 1%. How about next year? Plus 25% on the bottom line. And about the same thing for 2024. And what about revenues? Is PayPal going to go out of business? Are they done growing? Well, not according to analysts, plus 16% in 2022, and then almost 20% for the out years. Quick pause here before we move on to stock number 4. Using a lot of the Seeking Alpha website, as you can see here today. If you're interested in learning more about this amazing platform, make sure you check out my affiliate link in the description. That link offers a significant discount to a 1-year premium subscription on Seeking Alpha. This is a platform I use on the channel all the time, and I highly recommend it. All right, stock number 4 is Teledoc, and this one to me is an absolute shocker. The COVID king is already back down to pre-COVID levels. Look down here on the 5-year chart. Let me find February. And on February 20th, you were $115. Today, you're at $72. Did Teledoc make any more money during the pandemic? Let's take a look. All right, on our revenue side, this top row here, $553 million. They got over the $1 billion mark in December of 2020, and you're trailing 12 months just short of $2 billion with an earnings report here yet to come. Looking ahead here to the future, this stock is not profitable yet. They're grinding their way towards it. You're still off about $3 before you get a bottom line on this one, but you can see how the projections are coming in. They're getting closer. It could be 2025 or so before they hit full profitability. On a revenue standpoint, could grow as much as 85% when they report the final numbers from 2021. And then you've got strong plus 20% growth projected over the next few years. All right, next up is Uber. And this one makes a little sense, right? Because of the haircut they probably took in 2020 as people were sort of locked in their house. But let's see how things are going. Pre-pandemic, you're at about $40, maybe $41 on the right day. Today, you're coming in at $36. Let's look at the revenue numbers here. Go back to 2019, you had about $13 billion. Understandable small haircut here in December of 2020. So 2021, they've already eclipsed the progress that they made in 2019. And I think we can all say that 2022 is shaping up to be a much better year in terms of travel and tourism. All right, looking ahead, this is another company that's not quite yet profitable. You can see perhaps in 2024, they'll get to that spot. I do think they had their first quarter of profitability. That's off the top of my head. They reached some milestone in that regard. But just to be clear, this fiscal year, they will not report a positive EPS. However, you do see that they are inching their way towards it. You know, if they outperform, maybe they hit it in 2023. From a revenue standpoint, you've got great growth projected here in 2022 as things normalize even more, plus 57%, plus 21, plus 22. So if you slept through the pandemic and you had your eye on Uber back in February of 2020, good news is you can get it for even cheaper today. All right, number 6 on the list is OLED. This is Universal Display. It's a stock that I've had on my watch list for a long time. You don't see a lot of headlines about it, but they basically own all the patents and formalizations for OLED screens, right? Which are working their way into just about every part of the technology world. And I personally thought it was interesting because of all the technological advancements that have been made during COVID, particularly with screens and gaming and all that stuff. And yet here's a stock that if we go back to 224 of 2020, the price was $160. Today you're at 143. Pre-pandemic high for this looks to be about 212. All right, let's look at the revenues. You have $405 million in 2019. Despite production and supply chain challenges, they did manage to eke out a gain to $428 million. And then last 12 months, it seems like they're back on pace. We'll find out when they report their final fiscal earnings for 2021. All right, now this is a profitable company. You have 392 projected when they do report here shortly. Looking ahead to next year, plus 30% on the bottom line, plus 20% 1 year from there. And then revenue side, plus 28, plus 20, plus 15, even a plus 32 if you want to go out even farther. But long story short, again, if you took a pause on OLED back in 2020 and you didn't look at it for a long time, companies made more money. They're doing better things on both the top line and the bottom line, and the price is basically cheaper than you would have bought it for 2 years ago. All right, number 7, this one just hit the board today after missing some of their earnings guidance, down 31%, and that is Fastly. This is another one that had a lot of pandemic hype to it. But if we go back to 2020, 2020, the price was $24. Today you're at $19.91. On the revenue side, company hasn't been in business for a long time, but in 2019 they made $200 million. They upped that to $290. Trailing 12 months, the growth isn't as strong, but still growing to $339 million. On the earnings side, again, this is one that is still shooting for profitability, maybe in 2025, but your bottom line growth is limited. It does look like they're projecting some increases heading into next year, but on the top line growth for a stock that trades below $20, you've got plus 18, plus 19, and plus 20%. Now, obviously, the call out for this one is going to be to dig through whatever just happened on their earnings call. I'd have to take a look at it myself. But assuming they're going to continue to grow to at least some degree, you have a stock that's made a lot of progress over the next 2 years, yet still trades cheaper. All right, stock number 8 is Redfin. February of 2020, I see a price of $30.11. Just below that today at $29.37. On the revenue side, you scroll over here in 2019, $779 million. 2020, $886. And look at this, last 12 months, they've all but doubled. In 2021, they all but doubled what they did in 2020. So big top line growth in here for Redfin. Let's see what the estimates are going forward. Not profitable. Doesn't look like they have a target date for that here yet. And as a matter of fact, they could take a step back on profitability here in 2021. But let's check on the top line. 2021 estimate is plus 112%. Then you've got 35% and 25% revenue growth projected in the out years. All right, and in the same vein as Redfin, we have Zillow, ticker symbol Z. I own the ZG part of this stock, and this one's really like right at the line. I might be cheating a little bit, but if you go back to 2020, you had a price of $63.63. Zillow's at $63.97, but we're going to call it flat for sake of this video. Let's look at the revenue side. This is not going to tell the true story of Zillow because their revenues really did explode, but most of that was from the iBuying platform. So the business line that they're winding down was where they were, purchasing and flipping houses. However, I can tell you from somebody who studied the stock, their IMT segment, which is more or less the advertising and the agent relationships, that has grown significantly since 2020, and it's projected to do so again here in 2022. All right, on the projections, Zillow doesn't have a consensus EPS right now because there's so much ambiguity with them closing down that business line. And you can see that there's not a lot of excitement here in terms of year-over-year revenue growth. but there is revenue growth for the things that matter, which is the IMT segment. What is not going to grow is the money they make from selling houses, or I should say the revenue they make from selling houses, because they're winding that down. So I wanted to keep it apples to apples in the way I show you things, but you're just going to have to trust me with Zillow. The thing that we really care about here is the IMT segment of their revenues, and that is going to be going up. Okay, these last three are similar to Zillow in the sense that they're riding right on the line of flat to slightly under or slightly overvalued where they were in early 2020. StarBucks is our number 10 stock. And if you go back to January 17 of 2020, StarBucks was about $93. Today, you've got a few cents on top of that, but for all intents and purposes, we're back to square one when thinking about the last few years. However, on the revenue side, 2020, or let's look at 2019, so a full year of no COVID, took a small step back in 2020 by the tune of about $3 billion. Here we go in 2021, and you have eclipsed the money that they made in 2019. And from a TTM standpoint, you're ahead a little bit of October of 2021 already. Earnings projections for StarBucks, about a 3% increase projected on EPS, or the bottom line this year. That expands more in the out years. And on the revenue side, plus 12 or 13% here for 2022. And riding right along double digits, not quite, but getting pretty close for 23 and 24. All right, stock number 11, we have Disney. Disney, we know they did some good things during the pandemic as far as the streaming world is concerned. However, they did lose that park's revenue for a big chunk of 2020. So maybe this one isn't as surprising. I gotta say, I'm still surprised though. Now, back in February of 2020, you're about 139. Okay, keep in mind that their China parks closed way before the American parks closed. So I'm going to go back here to, let's call it December of 2019. You're trading about 150, 151 in that range. So this one is over a buck or two from that timeline, but for a company like Disney, I'm gonna feel pretty good calling it flat. All right, how about revenues for Disney? Last full year, and that's a good year because it ended in September of 2019. You've got $69.6 billion on the top line. Listen, October of 2020, all the things that happened to them, and they only missed out on $4 billion. That's a lot of money to us, but considering the park closures, I say they're doing pretty good. Now, looking ahead to October of 2021, you're at $67.4 billion. Comparing that to 2019, they were still short, $2 billion. But you see what's happening already with the trailing 12 months, which kind of spans over a couple fiscal years. You have finally made it over the hump of the comp for September of 2019. All right, earnings estimates, $4.44 projected for 2022. Strong growth on the bottom line for the next couple years. And then on the revenue side, big year this year for a company the size as Disney, plus 20%. And then you got double digits in 23. And maybe as time goes up, these projections tend to increase over time for quality companies. Wouldn't surprise me if Disney hits double digits again in 2024. All right, stock number 12, which is also so close to being flat, but it is just a step positive. If we look at Netflix, 220 of 2020, about 387, 386, so whatever, $5 or $6 more than it was back in early 2020. Obviously, Netflix was a major beneficiary of the pandemic, so to be honest with you, this one surprises me. All right, revenue side, 2019, you had $20.1 billion. 2020, you added about $5 billion or so to that. 2021, you added another $3 billion. How about earnings estimates for Netflix? Right now, you have basically flat for 2022, $11.15. Then you start to get into plus 30%, plus 26% over the next couple years. And from a revenue standpoint, nothing but double digits for as far as the eye can see. And despite all these potential tailwinds in the future, you can purchase your Netflix stock for $5 more than it was out there in February of 2020. All right, investors, so those are 12 stocks whose pre-COVID prices are at or below, or in some cases just a couple bucks over, what we saw in February of 2020. Out of this list, is there any of them that you're interested in looking into? Please let me know in the comments. Don't forget to check out that special offer from Seeking Alpha in the description. And as always, please give the video a thumbs up, subscribe to the channel, all the things. We'll see you on the next video.